session up and running. So we're going to have a quick look around the markets, but just to kind of give you a heads up, we're going to talk German politics, of course. We're also going to have a little catch up on Brexit, and obviously the Chancellor Hammond has a little speech to give tomorrow where he's going to deliver the budget. We're also going to cover what's going on with the US tax situation, and we're also going to have a little look into what's going on over in China, because they've introduced some new regulation for the financial system to try and clamp down on the shadow banking sector, which is quite interesting. So I think it's an important one to know about in the medium to long term. So that's what we're going. They're the topics hot off the press. But let's just have a look at the charts first. And as we do so, of course, we'll kind of tie in the Germans and the election, or sorry, the political developments, the lack of a coalition government. And you know, firstly, looking at the DAX here. So the German stock market took a leg lower, of course, off the open, spiking down to test the lows that we had from Wednesday last week. But once the market had gapped open, it did pretty much nothing but go up, and then indeed closed the gap. And indeed the official timings, as Deutsche Bank were pointing out this morning, the DAX was in negative territory as a result of the big breakup of these coalition talks, meaning that the pathway forwards for the German government is now unclear. The DAX was in negative territory for all of 1 hour and 16 minutes. That's how long it took to go from being down compared to Friday's close to being above Friday's close. And then of course it pushed higher and actually traded right up to test these key points from last week. So Thursday and Friday's high, just short of the 13,100 handle. That's kind of where finally the reversal kind of ran out momentum. We've been sideways and just a very touch lower just over the last hour. But as you can see, where we're trading right now, we're still right up at the top end of this range. It's quite a neat range now, actually, if you look back over the last 3-4 sessions, in fact. So a range that you definitely want to keep your minds on. So, you know, a lot of the talk is, well, how is it possible for these markets to be so immune to seemingly, you know, quite significant negative developments? And I would say there's, you know, now that the dust has settled, and by no means am I suggesting gap open lower on the DAX yesterday. I wasn't really anticipating the DAX to go and rally and test the highs from Thursday and Friday. I certainly didn't have that foresight. Obviously that's what happened. So after the event, you know, explaining why the market behaved the way it did is obviously easier with the benefit of hindsight, because you know what happened. But you know, I'd say two things. Firstly, I'd say whilst this political development is certainly a negative one, it's not, you know, anywhere near the kind of negative developments we've seen in recent times. You know, let's say these political shocks like Brexit, like Trump, for example. You know, this is nowhere near that kind of level. That's because of the way the German sort of political system and the rules are mapped out. You know, in the event that no coalition is formed, then there's no power vacuum where there's no government ruling. The rule is that the previous sort of government and the previous chancellor continue, you know, as a kind of stopgap makeshift chancellor. So there's no power vacuum here. And then secondly, you know, it's your opinion. All right, well, Merkel wasn't able to form this coalition, so you know, what happens now? And have a look at the graphic here, which is quite a nice sort of summary of the potential pathways forward. And you know, so the Jamaica coalition talks fail. So this is where you had obviously the FDP party marched out of the talks saying we don't want to govern. So where do we go? There's three options. Merkel could return to the grand coalition that's been in power for the last 4 years, and that was teaming up with the SPD party. And if I just remind you of the Bundestag seats here, Merkel's CDU-CSU has the largest amount of seats, 246. The second biggest party is the SPD. So together, those two parties easily form a majority, and it's those two parties that have been in a grand coalition for the last 4 years and governing. It was the SPD's choice to step out of that coalition this election, and they said, look, we don't want to govern, we don't want to be the junior member of a coalition government anymore, we want to be the main opposition party. So they've stepped out. Then, obviously, the CDU and CSU party said, all right, well, we need to team up with someone else to form a majority. They tried the Greens with the FDPs, because just teaming up with the Greens on their own, which would be the obvious fit, that actually doesn't quite get them over the line for a coalition. So they had to add on the FDP, and it's the FDP party that's pulled out of these coalitions. So let's go back to that graphic. One option, they go back to the format that we've seen in the last 4 years, team up with the SPD, but the SPD have said they don't want to do that. So that seems an unlikely path, unless the German president comes into play here and manages to broker some kind of deal which gets this coalition back together. But so that's one option, perhaps seems unlikely at the moment, unless the president can pull a rabbit out of the hat. The middle option here is, well, forget about the Merkel's party teaming up with anyone else. They'll just govern with a minority. Or they could add the Greens onto that, but they would still have a minority. Here, the reason why this is unlikely is because Merkel on TV yesterday said that that's not a pathway she wants to go down. She says we can absolutely form a majority government. You know, we're not interested in a minority. If we can't sort of coalition here, let's go back to the polls and have another snap election. And so that would be the third option, new elections. Now, you know, in terms of how that might track, obviously the risk here, if I go back to the Bundestag graphic, the AfD party are in the Bundestag for the first time ever. This is your kind of far sort of right-wing, anti-Euro party. And the fear is that perhaps they'll see even more support if the political establishment are seeming to, you know, unable to kind of form a government here. Maybe that throws a bit more support out to the flanks, to the far right and the left. But I think the strategy, the reason why markets are pretty calm about this, I think the FDP stormed out, and I think their strategy was to try and undermine Merkel. But it looks like Merkel's playing this quite well, in that she's pretty much shaping it so that people are seeing this breakdown of coalition talks as the FDP's fault. It's not Merkel's fault. Merkel and the Greens are very much on the same page and ready to roll, and it's the FDP that are to blame. And so if we have another general election, we'll see. It's hard to know how these numbers will shift. Perhaps they wouldn't shift too much, but so we still might be on the same page even after a second general election. It might be that these numbers don't change much, in which case, again, a coalition being formed might be tough. So we'll see. But in the meantime, the point is, from the market's perspective, it's not that big a deal. And actually, if you're looking at the DAX, one way to explain why we rallied here, you could argue, if you think about the ECB's angle, well, the ECB are in the process of trying to wean the system off monetary stimulus. But of course, any kind of bad news, any negative development in the economic system will mean perhaps they're going to have to wean us off this QE program slower, i.e. more quantitative easing. So it might be that the DAX benefited. It might be a bit of bad news is good news. As long as the bad news isn't too bad, well, then it's good, because the ECB in the end print more money. So maybe there's an angle there. But then, right, so here's the reason why that's not a perfect argument. So let's say that is a reason why the DAX rallied. Look at the Bund. Well, actually now, and it's been delayed, but finally you're seeing actually the Bund maybe respond with that kind of thought in mind, because the Bund gapped higher yesterday. Well, fine, that makes sense. Risk off to start with. But then the Bund reversed, but the Bund didn't then move down to test Friday and Thursday's low, which would have been the case if it was very simply risk off and then risk on. And here's the Bund just about to test yesterday's high. So the Bund is higher and the DAX is higher, indicating that there may well be a little bit of bad news is good news, more QE in the system here. So what about the euro's value then? Because if that is the case, then the euro should be weakening. What happened yesterday was quite extraordinary. Of course, let me just zoom in on yesterday's session. Of course, we weakened to start with a big gap lower. Then the euro strengthened, but you can see the euro weakened very quickly again. And actually, the euro's down around the bottom end of this chaos since the news from Germany broke. So actually, the euro's weaker, the DAX and the Bund are stronger. So actually now, after a lot of noise, maybe people are coming around to that thought, you know what, this isn't a disaster. Yeah, it's not ideal, but it's bad news, but it's not bad enough to kind of really derail this economic momentum we've got going in Europe. And actually, in the end, we might get more QE out of this, so happy days. So maybe there's an angle there, I think. But it's certainly not a straightforward one. Okay, so that's the Germans. We'll get more news flow, obviously, on this as this story unfolds. And really, at the moment, Merkel's pretty much looks like she's angling towards another election. Or maybe the president can pull something out here and try and get the SPD back into the grand coalition that we saw in the last government. Okay, moving on. Let's have a look at... I thought I'd give you a bit of an update on the US tax situation. And that's because it's going to be news. I got a couple of graphics here. I mean, obviously it has been news and it will continue to be news. Here's well, actually no, I'm going to show you this chart first. So tax reforms, where are we on this so far? And so what's happening at the moment is we've got this idea that they're going to try and get through some kind of corporation tax cut of the order of chopping it down to around 20%. So currently, as we know, the US have the highest corporation tax rate in the developed world at 35%, and they want to cut this to 20%. At the moment, you've got the House of Representatives. They voted through their proposal, and the Senate are almost there. Okay, we might get the Senate getting their proposal through next week. I think the Thanksgiving holiday is just going to get in the way of that. But we should get that done next week. What happens then is, well, they're two separate bills. And of course, in the end, we need one bill that both the House and the Senate vote through. And then the President can sign it off and it becomes law. So we're expecting this conference, this reconciliation of the two tax plans. We're expecting that to happen between December and January. And now they've put a big promise down that we're going to get this done by Christmas, but it looks like the Senate process has stalled a little bit, which means that timeline is now ambitious. So it may well be this gets pushed into the start of next year, where perhaps both chambers get this bill voted through some point in January or maybe even February, and then the President is able to sign it off. The one thing to think about is next year we have the midterm elections in November, and the Republicans are a little bit afraid about this. The Trump approval rating has obviously been very negative. They've inverted this chart, so the disapprove is on the top and approve is on the bottom, and as you can see, Trump's approval rating has been getting worse and worse and worse and worse, and he has the 11-month point of a new president's reign. He's got the worst approval rating in history. So the Republicans are a little bit nervous about how much damage Trump as their Republican president is having, on the broader economic climate, and so they're a little bit nervous. This is why they're desperate to try and get some positive legislation through the door, well in time for the run-in for this midterm election process in November. The closer you get to the summer months, then the less likely any new legislation is going to get done, because all these senators are out on the road trying to get re-elected themselves. Forget about trying to do greater good for the country. It all becomes self-obsessed. I want to make sure I get my seat. So if you get anywhere near the summer here, then this stuff's going to get shelved till 2019. So that's the time pressure. They've really got to get this done Q1 latest, otherwise pretty much it's not going to get done at all, perhaps. So that's an update on the tax. One other interesting story, a completely different one, and one we need to be mindful of. Well, actually, let me just finish on that tax thing by just checking in on US stocks and the S&P. So we had a positive session yesterday. This is looking back over this is November, looking back over the last 20 days. And you can see we're flat. This month, this market has not gone anywhere. I mean, we have set new highs. Those tops on the 7th and on the 8th of November were new all-time highs. If we draw the line in there, just shy of 2,600. We've been drifting lower, but then we had a nice push higher on Thursday last week. Sell off on Friday, but rebound yesterday. And so we're upper half of the November range at this stage. Things are calm. We've obviously got a shortened Thanksgiving week, so volumes are going to be very low this week, and at the moment traders aren't particularly bothered. It looks like they don't care so much about European politics or the German risk. What we do have though, and I showed a few of you this yesterday, is an interesting development with regards to the open interest levels on options on S&P 500 ETFs. And this has actually risen now to the highest level since 2011. We've just taken out the 2014 high. Go back to 2011, and you show a big spike to like 29 million. So this is a measure really of the open interest here. So you could say it's a gauge for how many investors are buying insurance and protection against the S&P dropping. So this is actually looking at put and call open interest. So there are some call open interest in here, which obviously is not talking about hedging against a drop. But you would assume the rise here, given the value of the index being at all-time highs, you would assume this edge up to the upside means investors are more and more leaning towards the idea that maybe this equity rally is towards its top and want to buy a little bit of protection. The last time we were up here in 2011, we had an absolute full-blown crisis as the Eurozone was almost breaking up. We obviously don't have we're not in crisis mode here, but it does reflect the fact that maybe people are beginning to think these US equities are very expensive. But if you look on a weekly chart, this is why. From 2016 January through to here, this thing's gone up, well, what is it, about 45%, I think it is. In less than 2 years. That's a nice return, thanks very much. Alright, that's the US equity space, still solid, still calm, still comfortable, up around this 2600 area. Here's a separate story for you. It's about China. So here's some news from overnight. Let me just get the graphic. So we've had some new regulation announced. This is part of China's ongoing sort of reforms, and one thing that's been of real concern is the explosive growth of what's called the shadow banking sector. I'm just going to scroll up before we look at that graphic. So if you look at this chart, China, shadow banking as a percentage of GDP, and it's grown sharply over the past 5 years here. Now, this chart here is looking at something called WMP. That's wealth management products, and they're the kind of lion's share. They're behind this big increase in the shadow banking, and this makes up 20% of debt funding. That's up from 4% in 2012. Okay, so WMP lending. Now this has been fueling the kind of ran the back door shadow bank loans. And this is potentially something that could come back to haunt China and us. And so what have China just announced? Well, firstly, what are these products? How are the banks doing this? Normally, in a normal system, if a developer wants a loan, let's say a developer wants to build a block of flats, right, we need a loan, so they'll go to the bank, and the bank will directly lend that developer money, okay? And therefore, the bank takes on that risk. In the system China have, the banks, to make more profit and to get this loan off their books, they channel this money through a trust company. So what happens here is the bank deposits money at the trust company. The trust company pays the bank a 9% interest for that deposit, minus a little bit of a fee. The trust company then actually lends the money to the developer, and the developer pays a 9% interest rate for that loan. Okay, over here on the right hand side, you've got the Chinese depositors, that's the people, that's the consumers depositing money, and they get a 5% return on that deposit. Okay, so here the bank makes a nice little spread of just shy of 4%, because you've got to take into account the fee that they pay to the trust company. Okay, so you get a 4% spread here than the bank's function. Now the key thing about the banks doing it this way is that they shift this loan, what is a loan to a developer, they shift it off the balance sheet, and it's therefore there's no guarantee on the wealth management product. It can be kept off the bank's balance sheet. This is the key. This is the shadow banking system. It's kind of got out of control, and it's ballooned, and there's a real risk if these developers start defaulting, then it might really start imploding the kind of shadow banking system, which would actually have a knock-on effect to the entire system. So what the Chinese have said is this is not allowed anymore. But obviously this is quite an important credit line for developers, and it's quite an important credit line that actually allows the economy to function. So stopping it in its tracks overnight would actually lead to a tightening of credit, and would lead to potentially quite a negative effect on growth. So what China have said is, look, we're going to stop this, but not until June 2019. So this is legislation announced now that doesn't come into play until for another 18 months. And the idea is that's enough time for the system to kind of wean themselves off this structure and onto something that's more stable. So that's news from China overnight. This needs to be on your radar. China reforms, if they manage these well, then fine. We're expecting growth in China to continue to drop into the end of this year and the start of next year. But if there's any kind of policy error in implementing these reforms, then it absolutely carries implications for the entire world. Okay, let's have a look at the calendar for today, and then we'll finish back on the charts. So here's the calendar in terms of economic data. We got some data out of the UK at 9:30. None of this stuff is massive in terms of market moving potential. We've got a US data release at 3 o'clock, which is the only one that's been put in bold here. That's existing home sales. We've had plenty of housing news from the US at the end of last week, Thursday and Friday. So again, this data, unless it's really bad, which is unlikely, it's not going to have an effect. We got Coer speaking from the ECB. We got Yellen speaking later on tonight. Something that reminds me, Yellen did announce yesterday that she is stepping down. Well, obviously she's been, well, sacked, I guess, as Fed chair, because Powell's been installed as her replacement from next year. But what Yellen announced last night, she's also stepping down from the Board of Governors. So actually this now means Trump has got 4 Board of Governors places, seats to fill next year. So actually that's quite important. There are 4 permanent voters on the FOMC, and he's installed Powell, but there's 4 others now. That whoever gets installed, that could have quite a dramatic effect on the Fed's overall leaning, you know, towards hawkish or dovish side. What we have with the rotation of voters for next year, the committee's getting more hawkish anyway, and depending on who Trump elects to kind of slot in there, we might have an even more hawkish committee. And then we've got to start thinking about the pace of rate hikes in 2018 and beyond. So that's something to be aware of. So Yellen will be stepping down as a governor. She will not be voting member next year. So we'll hear from her later on, but that's at 11 p.m. All right, let's just quickly finish on the charts. I've spoken about the kind of equity situation where you've got calm now, it seems, after maybe a slight, in the end, a slight sort of bad news is good news scenario with bonds now higher. Check the Bund, keep an eye on yesterday's high. The euro net lower off the German result. Let's have a look at sterling. Sterling had a decent day yesterday. We're obviously moving towards this budget from Hammond on Wednesday. And maybe there's a little bit of pre-positioning on that with a bit of upside on sterling yesterday. Also on Brexit, looks like Theresa May's got her wish. They had a committee meeting yesterday, and looks like the Brexit committee have given the green light for May to offer double double the funds for the Brexit bill. So you remember that at the moment Britain have only said we're willing to pay 20 billion euros as part of this Brexit bill. But it looks like May's got her wish to now go back with a concession and offer double that, maybe up to 40 billion euros. But the Brexiteers on that committee, the likes of Boris Johnson, have said, look, we're only happy for that to happen if we get something back. We can't just go there and say, look, all right, we'll offer double. We'll offer double as long as we get to now start negotiations on trade and we get confirmation of some kind of transition period for us to implement this new deal beyond March 2019. Okay. Now the timing for this, the EU summit, which has been the deadline that's drawn by the EU themselves, is on the 15th of December, and sufficient progress has to be made by the 15th of December, sufficient progress on the Brexit divorce settlement for then there to be enough time for these guys to move on and negotiate on trade in 2018. Now, Theresa May is believed to want to hold back this offer of doubling to 40 billion until the 8th of December is the plan, apparently. They don't want to go with that now. Barnier wants an update on this by the end of the week. That's the EU's chief negotiator. But May's likely going to hold off and go the week after. That's because then that will give the EU side less time before the EU summit to kind of think about it and come back with any kind of counter. So the plan apparently is she's going to leave this until the 7th, 8th of December, slap the 40 billion on the table and say, look, we want to move on to trade. This is sufficient progress. We want to talk about trade. We want a transition deal. And the idea is this all gets signed off at the EU summit on the 15th of December. So that's the timeline. For now, the pound is quite comfortable with this. If we look at a daily chart, then we're still tracking sideways after the chaos of September and October, and it looks like the pound's comfortable around here until we get into December and just see whether this plan of action on the Brexit is going to happen. If it does, we'll find cable can break higher as we in the second half of December. If this does get signed off when we move on to talk about trade, we'll find the cable can break higher up above 134. Maybe we might start thinking about more rate hikes from the Bank of England in 2018. If come the 15th of December this plan breaks down, there isn't sufficient progress, then we start talking about, well, no deal, hard Brexit, and this is where cable's going to smash back below 130. All right. For now, for the next 3 weeks, we're trapped between 134 and 130. We're stable. Maybe Hammond's budget tomorrow might breathe some life into this, but it perhaps won't be sustained because the bigger issue is that 15th of December timeline. Okay. All right, that's probably it for now from me. We will be on the mic through the session, but that's your briefing on this Tuesday morning. Enjoy the session, guys. Thanks very much.